Hey guys, what's up? I'm Erin and welcome back to the channel. There's a popular saying in that time in the market beats timing the market. That's simply when it comes to investing, the best practice is ABB, always be buying. And for most of us, that's how we default to investing. We save a little bit from each and every paycheck, whether that's on a bi-weekly basis or on a weekly basis. But for the sake of it, let's consider what it would look like if you were to invest at the absolute worst time. But then on the flip side, let's also consider what it would look like if you were to invest at the absolute best time. If you're an OG follower of this channel, you might remember that years ago I did a video talking about investing at the absolute worst time, featuring a character named Mr. Unlucky. Well, that video actually happened to be my husband's favorite video, and he's requested that I do a revamp of it. So that's what this is. But I thought I'd put a new spin on it. Instead of just doing the worst, let's do the best and the worst. So this time we're gonna have Mr. Lucky as well as Mr. Unlucky. Long term, the markets go up, which is really great for us as investors. And long term, that average rate of return has been about 10%. But just because we say long term the market goes up, it doesn't mean it goes up in a straight line. Far from it. There are lots of peaks and valleys along the way. So it goes up. It's just a very rough road up. Along the way, there's gonna be some really bad days. But on the flip side, there's gonna be some really good days. Consider this chart of S&P data. If you were somehow magically able to avoid the 10 worst days of every single decade going back to the 1930s, your returns would be over 3 million percent. However, if your timing was absolutely terrible and you missed just the 10 best days of every single decade, your returns would fall to just 28%. That's a 90-year time horizon. Let's first assume that we had an investor who magically had a time horizon like that, and let's assume that each investor started out with $1,000. The investor who avoided the 10 worst days of each decade would have ended up with over $38 million. And for the investor who missed the best 10 days of each decade, he ends up with just $1,280. And what about the investor who was in the market the entire time, missed no days? Well, he still ends up with almost $5.9 million. Now, if we could time the market and be right, that would be amazing. But if we're wrong, we lose big time, which is why it's best to probably just stay in the market, to capture all the days, good and bad, because you still end up in a great position. And consider that according to a study from JP Morgan, 6 of the 10 best days in the market occur within just 2 weeks of the worst 10 days. The market has the ability to pivot quickly, and its behavior from day to day is next to impossible to predict. Remember what just happened during the pandemic. The S&P fell 34% in just about 3 weeks' time. That drop wiped out 3 years' worth of gains. However, the market then quickly rebounded, giving way to one of the fastest bull markets in history and closed out the year up over 18%. What seemed like a terrible time to be in the market turned out to be a great time to be in the market. But as for the guys I want to feature in this video, Mr. Lucky and Mr. Unlucky, they aren't market timers. They aren't trying to jump in and out of the market, capture the best days and dodge the worst. Rather, as their name suggests, they're either just kind of lucky or kind of unlucky. Mr. Unlucky invests right when the market's at its peak. I'm talking the day before things start to go down. On the other hand, Mr. Lucky invests right when the market is at its bottom, right before it starts to rebound. But neither of them pull out their funds. They simply leave it invested. What do you think would happen to their portfolios over time? And let's say that our investors invest in a low-cost S&P 500 index tracking fund and they opt to reinvest their dividends. Remember, they're smart, they're just either lucky or unlucky. And let's say that each investor invests $10,000 in the year 2020. But Mr. Unlucky, he invested the day before the pandemic recession hit. And Mr. Lucky, he invested right before the recovery began. How would they be doing today? Well, Mr. Unlucky's portfolio would now sit at $13,400. And Mr. Lucky's portfolio? Well, he would sit at about $16,600. Yes, there's absolutely a difference, but the good news is they're both in the black. They're both up. So let's go back further to see how these differences play out over a longer period of time. This time, let's go back to the 2008 housing bubble and subsequent market crash, because that crash and the recession associated with it definitely left its mark on investors. We're going to do the same scenario. So investing $10,000, Mr. Unlucky, he invests at the absolute peak right before the recession hit. And Mr. Lucky, he invests right at the market bottom before the recovery started. And now 15 years later in 2023, here's how their portfolios would look today. Mr. Unlucky sits at almost $42,000, and Mr. Lucky, his portfolio sits at $65,000. Again, yes, there's a difference, but they're both wildly up. They're both in a far better position today than if they otherwise would not have invested. Say, left this $10,000 sitting in a savings account, or worse, just sitting in cash. One more example, let's go back even further this time to the downturn of 1973-1974, which at the time was the worst downturn since the Great Depression. And that was 50 years ago, and 50 years represents a good lifetime of investing. So we're going to use the same parameters for Mr. Lucky and Mr. Unlucky. What would happen to their $10,000 investment? Well, Mr. Unlucky would have a portfolio of $1.4 million, and Mr. Lucky, he'd have a portfolio of $2.2 million. I think it'd be safe to say that they're both lucky, or at least they're both in a better position today. Had you actually started doing dollar cost averaging when Mr. Unlucky did his lump sum investment, you would have actually come out ahead with $1.7 million. But if you started dollar cost averaging when Mr. Lucky made his lump sum investment, you'd actually come out slightly behind with $1.6 million. But either way, over the years, you can see you should be able to build great wealth. You're not likely to jump into the market at the very bottom of a dip, just like you're not likely to jump into the market at the very tippy top of a peak. These represent the most extreme scenarios. Rather, when you start investing, it'll probably be on a very typical but unremarkable market day. So your investments will likely fall somewhere in between on these situations. It won't be the very best scenario, but it also won't be the very worst scenario. In both of these situations, even the worst case scenario, the investors ended up in a fine place. If you invest diligently year in and year out, you will likely end up in a fine place as well, regardless of how the market is performing at any given moment. And this type of timing, where you're just waiting to get started, I feel like is the most common type of market timing, rather than that hopping in and hopping out of the market. You always hear people say, I want to get started investing, but the market's just too high right now, or I'll just wait for things to settle down a little bit, then I'll get started. But you have to remember, the market is always going to ebb and flow. There's always going to be good days and bad days. Odds are it's better to get started as soon as you possibly can. Could the market go down the day after you invest? Absolutely. But it could also go up. And remember that investing is for the long term. The price you're going to get today is likely going to look like an incredible bargain in 20 or 30 years' time. Because in 20 or 30 years' time, the market is likely to be in a much higher position than it is today, regardless of what happens in the weeks or the months after you start investing. So it doesn't really matter what day you start investing. What matters is that you start and that you stick with it and you stay invested. And speaking of market returns, perhaps you've heard of the rule of 72. It's this old investing rule that will estimate the number of years it will take an investment to double based on the rate of return. The higher the interest rate, the quicker the investment will double, and vice versa. Pretty common sense, right? How you run this calculation is you simply take 72 divided by the rate of return, and that will give you the expected time in years for the investment to double. So for example, if you anticipate an 8% rate of return, you can expect the investment to double in 9 years. It's a handy little rule of thumb to keep in mind when it comes to your investments. It also highlights the importance of getting started investing early, because the earlier you get started, the greater number of opportunities you give your money to double. Let's say that you use an expected rate of return of 7 or 8%, which means that you can expect your money to double about every decade or so. If you start investing at 20 with a goal of retiring at 60, that means your money would have 4 opportunities to double. But if you wait and start investing at 30, well, now your investments only have 3 opportunities to double. So all else being equal, theoretically, you can double your ending balance simply by getting started a decade sooner with that very first paycheck. Now, very important to keep in mind that the rule of 72 does not take into consideration any additional amounts invested. It simply looks at what time it would take an investment to double at a specified interest rate. The big takeaway is we have no idea when the market's best days are going to be, nor do we know when the market's worst days are going to be. And if someone tells you they know when they're going to be, run from that person. A better strategy, rather than spending any mental energy trying to figure it out, is to simply ABB, always be buying, because the surefire way to hit your goals is to actually get started investing. So what do you guys think? Leave your thoughts in a comment down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye.